Greetings, my beloved clients. I was thinking about you guys this morning on my hike, and I wanted to share with you one of the strategies that we employ in the portfolio, and it's called 10 baggers. That's a phrase that was coined by the great Peter Lynch. Now, Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990. And he turned that fund into one of the largest mutual funds in the industry. And over that 13-year period of time, he averaged, I believe, 29% returns annually. He became a legend. He wrote a book called One Up on Wall Street. And then he retired at the age of 48 because he had made enough money and he wanted to spend some time with his family. But in that book, he talks about many strategies, but one of them was this one that he called 10 baggers. And a 10 bagger, as he defines it, is a company that you buy and the price increases 10 times over the time you own it. So if you bought it for 100, over that time, the price went up to 1,000. So, and he had several of them over the time that he was managing Fidelity. And it's one of the things that he was famous for, among many. He was a great value investor, cut from the same cloth as Benjamin Graham and Warren Buffett. And so I want to talk to you about the 10 bagger strategy and risk management using the 10 bagger strategy. Okay, so Benjamin Graham is the guy that coined the phrase margin of safety. I've told you guys before that margin of safety, the three most important words in investing. So if you come to my house at 2 a.m., throw a glass of water on me, and you ask me, what are the three most important words of investing? I should yell out, margin of safety, before I even wake up. Okay, so, and in his book, The Intelligent Investor, chapter 20 was dedicated to margin of safety. That was by Benjamin Graham. And he defined margin of safety as various definitions he used was either a 33% discount to its intrinsic value or 50% above the purchase price, which is the same thing. So basically he's saying if you buy something for $10 and you believe the intrinsic value is 15, you have enough margin of safety to protect you if your calculations are off a little, or whatever, the market doesn't totally agree with you over time. And so that was the margin of safety he was looking for, right? So if it's at $10 and it goes up to 15, that's 50% appreciation. Or if it's worth 15 and you buy it for 10, that's a 33% discount, just depending on which way you do the math. But that's the margin of safety he was looking for. And so he was practicing in the 30s, 40s, and 50s. And he said, what you want to look for is mispriced stocks. Stocks that the market is not correctly pricing in the intrinsic value. But you got to remember, during that time that he was practicing, there was not a lot of information. There were no computers. There was no internet, right? So to find information, you either had to go to the library and thumb through this S&P book that came out once a quarter, or if you can afford to, subscribe to it. And every quarter you get this big telephone book of annual reports. And obviously few people did that, and even fewer really read them, and even fewer really understood them. And the appetite for stocks wasn't that high. The country was in the middle of a Great Depression, and then later in the middle of a world war. And people still remembered the roaring 20s and the stock market crash of 29. So there were opportunities to find these mispriced stocks if you're willing to do your homework. And so when he was looking, he said, if I could buy this thing at a 33% discount to what it's worth today, he was just looking at the value today. I could find these and I could do well. And he did find them and he did do well. And Warren Buffett was his star pupil, who went to Columbia in 1949, I believe, took his class and went back to work for him in the early 50s, and finally started his own shop around 1955. And he employed that strategy, and also with great success. And he told his partners, he goes, my goal would be to beat the market, which at the time he was talking about the Dow, by 5 percentage points. Employing this strategy, this margin of safety strategy. And guess what? He did. He actually beat the market by 10% average over the time that he ran his fund in the 50s and 60s. Now, by the time Warren Buffett was doing it, the country was past the Great Depression. It was past World War II, and it was entering a period of prosperity, and the market started doing well. More people started to get involved, and there was, a little bit better technology. So, by the time Warren Buffett, by the time the end of the 1960s, Warren Buffett was finding it harder and harder to find these companies that were trading at a 33% discount to intrinsic value. There was just more eyes on the market, and these discounts were shrinking over time. And in fact, in 1969, he shut down his partnership. He said, I know we've had a lot of great success, but I'm finding it harder and harder to find these kind of values. And I'm concerned I won't be able to perform for you the way I had promised. And he shut down his partnership in 1969, gave the investors their money, and he had, prior to that, he had bought one company called Berkshire Hathaway, which was a textile company in New England, and he stayed on as the CEO of that company and basically got out of the investment management business. He was just managing his Berkshire Hathaway portfolio. He was managing it like an investment manager because he didn't really want to be in the textile business. He liked the cash flow, and he would invest that cash flow in whatever he wanted, insurance companies or anything. But so he retired from investing also at the age of like 39, a millionaire, and just went off to run Berkshire Hathaway after having had a tremendous track record using this margin of safety principle. But so then in the 70s, he kind of tweaked that strategy a little bit, in that instead of looking at what is this company worth today and can I find it at a discount to what it's worth today, he said, what if I look at go out 3 to 5 years and look at the value of this company based on reasonable assumptions over the next 3 to 5 years. And using that method, he was able to find companies, again, with a sufficient discount to intrinsic value. Rather than value today, he's talking about value tomorrow. But it's still the same margin of safety strategy. And because he was going out farther, the margin of safety number that he wanted was 100% or a 50% discount, So if he saw something worth 20, he wanted to buy it for 10, right? So it's a bigger discount because it's a longer hold period. But it was the same strategy, okay? And he, in the 70s, 80s, and 90s, even into the 2000s, but less so, he had great success with his version of this margin of safety strategy, looking out 3 to 5 years and discounting it back 50%. So he liked to say this. He said, I like to buy $1 for 50 cents because if I do that, I have enough margin of safety. And when he said $1, he meant, I think within 3 to 5 years, it'll be worth $1. And today I could buy it at 50 cents. Okay. So if you consider Benjamin Graham's strategy of buying it at a 33% discount or with 50% upside, if that happens in 1 year, if you buy something for 10 and in 1 year it grows to 15, then you get a 50% return. If it takes you 3 years for it to go from 10 to 15, then you get a 14% return, which is still pretty good. And he was saying, in the 20s, 30s, 40s, it might take the market 1 to 3 years to realize they had mispriced this company. Okay, so using Graham's strategy during that time, if you can find those type of companies, you can expect, when you're right, to get anywhere from 14 to 50% returns. Depends on whether it takes a year to materialize or 3. Okay, which is pretty good. And for a low risk strategy, because remember, you're buying it for a discount to intrinsic value. That's how you're protecting yourself from risk. And he's not worried about the risk of fluctuation. He's worried about the risk of permanent loss of capital. Okay, so now compare that to Warren Buffett's strategy, where he says, well, I want something that is maybe at a 50% discount that could double over the time I own it, right? I want to buy $1 for 50 cents. And I'm willing to hold it 3 to 5 years. So if that doubling materializes in 3 years, you're at a 26% return. If it takes 5 years, you're at a 14.86% return, which is really good, right? So if you're right on this strategy, you could expect market beating returns in the range of, 15 to 30%. Okay, so now let's compare that to the 10-bagger strategy. Now in the 10-bagger strategy, we're looking out a little bit farther, and not what it's worth today, what it could be worth in 3 to 5 years, but we're looking at this company and we're seeing the potential of the market, of the management, of the product, and just the way the world is going. And we're saying, I could see this company being worth 10 times what it is today if I'm willing to hold it 5 to 10 years. Okay, so, but it's the same strategy. It's a discount to intrinsic value, but we're looking at the intrinsic value out farther. We're not looking at the intrinsic value today or the intrinsic value in 3 to 5 years. We're looking at the intrinsic value in 5 to 10 years. But we're requiring a much bigger margin of safety. Warren Buffett likes to say, I like to buy $1 for 50 cents. But in the 10-bagger strategy, we say, well, I like to buy $1 for a dime. Now, tell me, is that a big margin of safety if you're buying $1 for a dime and you're willing to hold it 5 to 10 years? So if that materializes, okay, if that materializes within 5 years, you're up 58% over those 5 years. If it goes from $10 to $100. If it takes 10 years, you're up 25%. Okay, so it's what the point I want to make is the 10 bagger strategy is I'm still a value investor along the lines of Graham and Buffett. We're just looking out farther. One, there's too many eyes on the market to find those opportunities at today's intrinsic value. And there's more information to be able to look out 5 to 10 years and see the promise of these upcoming companies. And so that's one of the strategies that we employ. And it also takes advantage of the inherent nature of stocks in that there's an asymmetric risk. Meaning, if you bought a stock for $10, what's the most you could lose? And the answer is $10. But what's the most you can make? And the answer is more than 10. It could go to 20, but it doesn't have to stop there. It could go to 30, 40, 100, 1,000. So there's an asymmetric risk. And when as a long-term investor, if you're looking for companies with this good long-term potential, you're putting yourself on the right side of that asymmetric risk-reward paradigm. Because the most you can lose is 10, but the most you can make is unlimited. And so let's say you had 10 companies that you thought were 10 baggers, and you put $100 total, and you put $10 each. And let's say one of those became a 10 bagger, 9 of them went to zero. How much did you make, or how much did you lose? Nothing. You started with 100. One of them went from 10 to 100. The other 9 went to zero, so you ended with 100, and you broke even. That's if you were completely wrong on 9 of them. So what if you're only right on 2 and completely wrong on 8? You doubled your money. So you're putting that asymmetric risk reward to your advantage, as opposed to trying to buy stocks for a 10% upside potential or 20% upside potential. In my mind, that's very risky, because if your upside is 20%, but your downside is minus 100, you're taking more risk than your potential reward. So if you're willing to have a longer hold period of time and look for companies with great long-term potential and buy them at a discount to intrinsic value, you give yourself a good margin of safety, and you give yourself a big upside. Now, it requires patience, because one of the things that causes volatility in the market is different opinions. So the stock market is a price discovery mechanism, and you know, participants are trying to discover the price of this thing. And if there's a big difference of opinions, well, there will be a lot of fluctuation until the market figures out, oh yeah, this is a winner, and then the fluctuation levels off. So the ones with the most potential are the ones that the market doesn't understand, or that's not willing to look out 10 years, because the market doesn't like looking out that far. They like looking out day by day. So we're in a great position in that when we're looking at 10 baggers, or we're looking out 5 to 10 years, we don't have a lot of competition. Not a lot of investors are willing to look out that far. And so it gives us an advantage in many respects. So that's all I want to say about 10 baggers for now. I have a lot more to say, and I'll share that with you in coming videos. But I just want to talk about the risk management when investing in 10 baggers, and to let you know that we're not trying to take a lot of risk, and if we do it correctly, we're really not taking a lot of risk, because we're buying at such a big discount to its long-term intrinsic value. Okay, so hope you guys have a great day. I'm heading off to the top of the mountain.